In 1887, I saw a tough old rancher named Billy Joe lose 500 acres because of one piece of paper he didn't read twice. A banker handed him a note, said it was a fair deal, low interest, easy payments. 6 months later, that same banker owned Billy's land, his barn, and damn near his boots. Now, you might think that was a story from a dusty trail long gone. But Hoss, the same thing's happening right here in 2026. Only now, they don't call it a land note. They call it adjustable rate mortgage, credit expansion, flexible interest. Sounds mighty fancy, don't it? But the pain under it's the same. Most folks think they're playing it smart. They hear the banker's voice on TV say, low rates, easy financing, buy now, pay later. So they saddle up on loans, house loans, truck loans, them shiny card debts, thinking they'll pay it off when things get better. But when the Fed hikes rates from 2% to 7%, that same loan turns into a rattlesnake that bites them every month. Let me give you plain numbers. Say you took a $400,000 mortgage back in 2021 when rates were sweet at 3%. That's about $1,700 a month. Now in 2026, that same note's carrying 7%. Your payment jumps to near $2,700. That's $1,000 gone. Same roof, same house, just different rule book written by the feds in D.C. And that $1,000 ain't just lost money, it's lost freedom. You work extra hours, you chase overtime, just to keep up with a banker's pen stroke. Folks tell themselves, it's normal, that's how the system works. Well, yeah, partner, that system's built so you keep working for paper that's worth less each year. Inflation, they call it, like it's some natural dust storm you can't control. But let me tell you, storms got causes, and this one's man-made, printed straight out of Washington. See, the Fed prints debt, not wealth. Every dollar born's got a little chain on its ankle, called interest. When they pump money into the market, prices rise, your savings shrink, and the same loaf of bread costs you more sweat. But they tell you it's progress, 'cause your wage went up $3. What they don't say is that your rent went up $5. I've been around long enough to see men lose more than cattle. They lose hope, 'cause they trust the wrong promise. Back in 1887, it was gold notes backed by trust. Now it's credit backed by the Fed. Same bottle, new label. You might think you're doing everything right. Paying bills, saving in the bank, following the good advice on TV. But that advice was written by the same fellers who profit when you stumble. And if you don't see the trap yet, sit tight by this fire, Hoss. Next, I'll show you why the system's built like that and what it's feeding off. In 1891, down in Dodge City, a feller named Clarence thought he'd outsmart the bank. He sold his steers for paper dollars instead of gold, figuring it was the modern way. By spring, that paper bought him half the grain it used to. Clarence blamed bad luck. I told him luck ain't got nothing to do with a stacked deck. Now here we are, 2026, and that same deck's still stacked. Only now it's got computers dealing the cards, and bankers calling it monetary policy. You see, the problem ain't just bad spending or lazy saving. The real trouble sits deep in how money's born and how it dies. Every dollar in this country is printed as debt. That means for every buck you hold, someone, somewhere, owes it, with interest on top. The Fed don't print wealth, it prints obligations. So when they say stimulus, what they really mean is more chains on the same folks. The system feeds on motion. It needs you borrowing, spending, refinancing just to keep the wagon rolling. Stop moving and the whole herd stalls. Trouble is, most folks' incomes don't grow as fast as them debts. From 2010 to 2026, Average wages crawled up about 45%, but housing costs soared near 120%, and college debt tripled. So when people try to live within reason, they're playing defense on a tilted field. And when the government says inflation's 3%, that's because they measure the wrong damn basket. Your groceries, rent, and insurance ain't in their fairy tale math. I'll give you one plain example. There's a young rancher out in Amarillo, name of Cody. Runs a clean operation, good credit, always pays on time. But every year his feed, fuel, and property taxes climb faster than his beef price. He refinanced his loan twice, thinking lower monthly payments meant he was winning. Truth is, he stretched his note another decade, and now he owes more total, even after paying 5 years straight. That's how the bankers keep a man riding, but never arriving. Standard advice says, saving dollars, work hard, trust the system. But let me tell you, that advice came from the same stable that owns the horses. You save in a currency they inflate. You work in a system that taxes a gain it never guaranteed. And you trust financial gurus who get paid when you buy the very funds they're selling. That ain't guidance. That's bait. Back in my day, we called it debt peonage. Now they call it financial literacy. But the result's the same. You stay on the treadmill till your knees give out. There ain't no stable ground when the system's built to sink a little each year. See, the structure rewards the few who issue money, not the millions who earn it. It's like a cattle auction where the auctioneer takes a cut of every bid, whether you buy or not. And that, partner, is why standard advice keeps failing. It's not bad math, it's bad design. So when you ask me how to fix it, I'll tell you. You can't play straight poker in a crooked game. You gotta change tables entirely. And that's exactly what I'll show you next. In 1895, I rode with a fella named Raymond over in Kansas. Smart man, strong back, always talking about expanding his ranch. One spring, he borrowed big at 6%, bought new land, and figured prices would rise forever. 2 years later, drought hit, markets dipped, and them same bankers who shook his hand were auctioning his cattle. He lost it all. Not because he was lazy, but because he believed growth was guaranteed. And that's the first mistake, partner. Believing the good times last forever. People in 2026 still play that same tune. They see a few fat years and start spending like tomorrow's booked solid. Cheap credit makes them feel rich, but it ain't their money. It's rented hope. You don't build freedom on borrowed sand. The second mistake I seen 100 times, holding savings in the same currency that's sinking. Say a man piles up $50,000 in cash savings over 10 years, keeping it safe in the bank. With inflation chugging around 6% a year, that pile loses near 45% of its real value by year 10. What used to buy a new Ford truck now barely buys the engine. Folks think they're protecting themselves, but really they're letting quiet theft eat them alive. Third mistake, chasing lifestyle before stability. You see it everywhere. A man earns $4,000 a month but spends $3,900. He thinks he's fine, but inflation don't wait for your raise. In 5 years, when prices climb 30% but wages only 15%, that same man's in the red, not because he stopped working, but because his decisions locked him into fragility. Fourth mistake, treating debt as leverage instead of liability. Some feller'll tell you, my loan's making me money, I'm using the bank's cash to grow. Well, sure, till rates double. Take a $300,000 loan at 3%. Easy enough, that's around $1,265 a month. When it hits 6%, that payment jumps to $1,800. That's $6,400 extra a year. About one whole month's work for a man earning median income. You don't need to be broke to feel broke. You just need a few rate hikes. Fifth mistake: trust in experts over arithmetic. Advisors say, stay the course, markets always go up. Maybe they do over 50 years, but you ain't got 50. Most families live check to check, investing blind in index funds without understanding the cycles that destroy value in between. If your money halves before it doubles, your real time to growth doubles too. That's math, not myth. Over 5 years, these choices look small. Maybe an extra coffee here, a debt there. Over 10, you're a paycheck behind. Over 20, you wake up owning less than you did starting out. The pattern's clear. The trap ain't built on poverty, it's built on routine. I've seen rich ranchers crash harder than broke cowhands, 'cause the problem ain't size of income, it's structure of decisions. Money's like a wild horse. You don't control it with wishes, you corral it with discipline. Now pay attention, hoss, 'cause next I'll tell you the way I broke that cycle, back when the banks tried to bury me with paper, and how you can do the same, right here in 2026. When the drought came in 1899, I didn't run to the bank, I ran to my barn. Dug up a sack of gold coins I'd buried 5 years prior. That gold didn't care about no market crash or banker's promise. Same weight, same shine, same power to trade. That's when I learned, real wealth don't need permission. Now listen close, hoss. The way out of this trap ain't fancy, and it ain't fast, but it's solid. The old-timers called it hard savings, and the new kids call it sound money. Whatever name you stick on it, the rule's the same. Store your value where no one can print it away. Step 1. Cut dependence on paper promises. That means keeping your savings outside the inflation machine. Some folks do it in gold, some in Bitcoin, some in productive land. Doesn't matter which saddle you ride, long as it ain't tied to endless printing. Let's take Bitcoin for example. Capped at 21 million, no central banker can adjust supply. That makes it scarce by design, same way gold's scarce by geology. Step 2. Build a real buffer before you chase growth. I tell folks, don't invest before you've got 6 months of your life covered. That's your freedom fund. No speculation, no risk, just security. Inflation might nibble at it, sure, but debt eats whole pieces, so keep your balance. Cash flow's your oxygen in bad weather. Step 3. Replace bad debt with productive debt. There's good loans and bad ones. A truck loan at 8% that don't earn you income? Bad. A small business loan that doubles your output? Worth considering. The rule's simple. If it don't pay itself back within 5 years, it owns you. Step 4. Stack what holds value across decades. Gold's been money for 5,000 years, and land's been wealth since man fenced the prairie. In the 1970s, gold was $35 an ounce. Today, it's over $2,000. That's not luck. That's math versus inflation. Same with land. They ain't making more of it. You want stability? Anchor your savings to limited supply. Now, some fellers say, that's too slow, Nat. I want fast money. And I tell 'em, fast money's like fast horses. They break quick. The man who wins long term ain't the one who gallops hardest. It's the one who stays in the saddle longest. This here system ain't flashy, but it don't collapse when rates rise or markets panic. You see, stability comes from control. When your wealth sits in assets the Fed can't inflate, your sleep gets deeper and your worry gets quieter. The banker's news won't shake your hand or your heartbeat. My old rule was simple. 1/3 land, 1/3 hard assets, 1/3 liquidity. That balance carried me through panics, wars, and them slick-talking salesmen with new names for old traps. So don't chase miracles. Don't fear the headlines. Build your base like a ranch fence, post by post, line by line. That's the only kind of wealth that stays when the wind shifts. Next time, I'll paint you the full trail, 10 years ahead, what changes, what don't, and how a free man keeps his ledger clean while others drown in credit. When I built my ranch after the panic of '93, I didn't do it by luck or by gambling. I did it with a plan. One post, 1 acre, one goal. Never owe a dime I couldn't pay, and never trust a man who prints what I earn. Now, you want a system, not a sermon. So here's a map you can ride from today till 2036 and come out standing tall. Year 1. Clean the stable. Stop borrowing fast money. Cut every debt that don't serve your future. Cars, gadgets, shiny junk. Don't worry about getting rich yet. Worry about stopping the leaks. Every dollar you don't owe is a dollar that can breathe. Start a 6-month freedom fund. Keep it liquid. Keep it simple. It's not for profit. It's for survival. Years 2 to 3. Build a hard base. Once you ain't drowning in bills, shift some savings into solid assets. Could be gold, silver, Bitcoin, or real land. Something no bureaucrat can conjure out of thin air. Split it smart. Keep part of your wealth in hand, liquid, part in store, hard, part in motion, income projects. Don't chase hype, chase endurance. Years 4 to 5. Grow with purpose. Use good debt to expand production, not consumption. If you borrow, make damn sure that loan earns more than it costs. Open small businesses. Invest in skills that make income, not followers. Save 20% of everything you earn, automatic-like. By the end of year 5, the wagon should roll itself, even if you take a month off. Years 6 to 10. Build freedom, not fortune. Freedom means your life don't swing with interest rates. With half your income from assets, not labor, you can weather whatever the Fed dreams up next. Maybe you own a small patch of land that rents steady, or a few ounces of gold tucked away where inflation can't find it. When markets panic, you sit like a rock, not a leaf. Now let's talk about what changes. In 1 year, you'll feel clearer. Fewer bills, fewer lies. In 5 years, your balance sheet starts working for you. Cash flow steadier, savings real, not just numbers. In 10 years, the system don't own you anymore. You sleep through their crises because you built your own weather shelter. That's the truth of money, Hoss. It ain't how much you earn. It's how well you control the game you play. There's always going to be new tech, new currencies, new promises from polished banker fellers. But the rules of freedom ain't changed since my day. Spend less than you make, store what's real, and never let another man's pen decide your peace of mind. That's what I did. That's what you do. And 10 years from now, when the dust settles and the banks shift again, you'll still be sitting by your own fire, debt-free, steady-handed, and free as a rider under God's open sky.